Another listless day for stock markets today as we await what is seemingly this week's, let's call it tentpole risk du jour. Last week it was a speech from Fed Chair Powell. This week it's an earnings report from NVIDIA as a kind of gut check on where we are in the AI melt-up sentiment conversation that has been defining markets in recent months, and frankly, at this point, approaching a year. But we are going to look under the surface and consider, on the other side of this quiet, on the other side of this lull, where might the markets find their bearings? And once the dust settles on this NVIDIA earnings announcement, what might be the trend default and the path of least resistance? This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And the focus today might come from a somewhat unexpected corner of the financial markets. And as ever, when we go on these kinds of side trips, they oftentimes take us into the land of currency, because it is here that we oftentimes find the underlying monetary flows that then echo into other assets. And in this case, especially while we are pondering what the Fed is going to do next, it beckons us to look at sort of why the markets became so taken with this more imminent arrival of Fed rate cuts that started to be the main catalyst for speculation on Wall Street and outside of it in early July. And perhaps if we can understand that, we can sort of figure out some early signs here. And as the argument that we've developed here on Macro Money has gone, there's all kinds of symptoms that people point to. The sharp move in the yen, the sharp sell-off in Japanese markets, the very dramatic spike in volatility on August 5th, all of these things. All of these things are symptoms, but the underlying concern seems to be recession risk. So it is with that we turn to currency markets to see where that story is heading, even as the markets are listless in the near term. And not surprisingly, this takes us to a conversation about the Australian dollar. Now, this is where things get interesting, because not only do we have here the possibility for an interesting move in its own right, a tradable move in the futures market just on local Australian grounds, we may also have a signal for what beckons later and what is likeliest next for the likes of the S&P 500 and the NASDAQ. Consider where we are here. This is the 6A continuous contract, Australian dollar and US dollar terms. And what you see here is that this kind of seesaw that we got in the closing 3 weeks of July, and then the rapid rebound so far in August, largely echoes the very same things that we saw in global equity markets. This here and this are the same moves as this and then that. And of course, at the top here, we have the S&P 500 in the green. We have the NASDAQ in the red. On the bottom here, to show that these are not just U.S. market moves, but global ones, we have the MSCI All Country World Index in the blue. And just to make sure it's not just U.S. markets being large and crowding out the influence of other markets, notice It isn't that either, because in the green we have the ETF that tracks that all country world index, excluding the US, and the moves are the same, which is to say, global sentiment in equity markets peaked out in early July. It has, of course, since rebounded with a tremendous amount of vigor, but the highs here remain intact. And so when we look at this, we are, as ever, reminded that the reason this happened had to have been something well before the Fed's or the Bank of Japan's policy announcements on July the 31st. It had to have been something else entirely. And what we find, of course, is that this is exactly the point where Fed Chair Powell started to initially signal to the markets that the Fed is ready to cut, that it has seen enough of the labor market to now think the risks to overshooting and having unemployment that's too high are about on par with overshooting and having inflation being too high. And so the singular focus on inflation that was there before was gone. A renewed focus on unemployment and thereby on economic growth was now the way the Fed was going to steer. And so with that, we get the market saying, whoa, okay, so the Fed now sees a level of urgency in cutting rates. What must they perceive about the economy? Have they perhaps already over-tightened? And of course, the price action in Fed funds futures would suggest as much. Because what we've seen since the Fed adopted a resistant stance to cutting rates earlier in the year, the market said, well, you don't want to commit to more than one cut in 2024. Well, that means you're going to have to do double all of the cuts that you were going to do in 2025. In fact, there seems to be something like a 1.5 to 1 to 2 exchange rate between rate cuts in 2024 and rate cuts in 2025, where shaving one cut away from this year ends up moving a cut and a half or two cuts into 2025's outlook, because the markets are betting that the Fed is, in its delaying, going to be late, miss a downturn in the economy, and have to scramble with cuts to catch up. It is perhaps not surprising against this backdrop that if the market was anticipating in April that the Fed was going to do 75 basis points in cuts in total between this year and next, and by June, the end of June, that number had nearly doubled to 133 basis points, that when then Powell comes out in early July and says, okay, we're ready to cut, the market says, yeah, you've been looking late for a few months now. So your readiness to cut is no longer a positive indication of you being early to catch what is a disinflationary cycle that is on good footing, and to smooth the economy's way into it. What you're doing is now having to catch up because you've perceived something negative on growth, and now the pain, at least in an outlook sense, is starting to look intolerable enough to act with urgency. And so when that message comes out from the central bank, the markets swoon. It is, of course, that same swoon that we see in the Aussie dollar. And it bears understanding why. When you get that initial move here, it doesn't necessarily say anything about the Aussie dollar per se, except to say that stock markets are falling and money is going to cash. The cash of choice typically in these situations is the US dollar because of its unrivaled liquidity. It can absorb a lot of money coming in without moving too much. It can absorb a lot of money coming out once investors are ready to take more risk without moving too much. And so it is a natural sort of cash out venue. It is also important to keep in mind that the Australian dollar is ultimately a reflection of Australian monetary policy expectations, which are in turn a reflection of the Australian economy's makeup and trajectory. And Australia is one of the most prodigious commodities exporters in the world. That, of course, means that it's relatively early in the global business cycle and relatively sensitive to changes in that cycle. So when there is a fear of recession, that understandably echoes in the Aussie. Sentiment deteriorates, Aussie dollar falls. Here's the August 5th crescendo here. And as sentiment recovers, so too does the Aussie, especially as money comes out, back out of cash and into financial markets. And so we find ourselves at an auspicious spot. We're right pretty much at the 68 figure, which is the midpoint of this area here, where the immediate bottom seems to be around the 67 figure, and the next major top is just under 69. So we're right in the middle there. And either we are going to break this high and then test this one, or we're going to decline, and this is the first inflection point on the way down. So the place we sit at is one where we are at something of a crossroads. Either we are going to overcome this swing top, or it's going to hold. And in answering this uncertainty, we are perhaps not just going to get an answer, as we mentioned, about the Aussie, but about this broader dynamic, which, as we can see, the Aussie is a very close reflection of. We have on the menu for today the release of the monthly inflation indicator from the Australian Bureau of Statistics. And this is something that's expected to give us the lowest inflation reading, we can see here, in some months, going back about to February or so. And that'll be 3.4% year on year if expectations hold. The monthly indicator is a relatively novel thing for Australia. It's only been introduced over the past 5-6 years or so. And the RBA still focuses on the quarterly numbers to set policy. But how we are going to respond in the face of this indicator might actually be quite telling. We can see here that recently there's been something of a positive development in Australian growth dynamics. So we can see that while manufacturing here, this is manufacturing PMIs from S&P Global, while manufacturing has been about as anemic as it has been globally, we can see across major economies, the manufacturing sector has been variously shrinking over the past year and a half. We also have a welcome upturn in the service sector, and with it a little bit of a pickup in overall growth. We can see here that for some months, Australian economic activity growth, overall services and manufacturing, was slowing. This is the composite index here in the yellow bars. As a matter of fact, in July's numbers, we actually saw a mild contraction. As ever, in the logic of PMIs, 50 is neutral. So when you get this little bit under 50, it's telling you the economy is actually contracting. Under 50 is contraction. Above 50 is expansion. The further you go above 50, the faster the expansion. The further you go below 50, the faster the contraction. So on the surface, it looks like there's been a little bit of a pickup here in August after a run of disappointing readings in the preceding 4 or 5 months. But then a look at the surface reveals something troubling. And this is a screenshot directly from that report. Notice here, input price is actually rising and is at the highest level recorded at any time in the 5 years prior to the pandemic. So businesses are facing increasingly high input cost inflation. But the final price index is actually down. In fact, the disparity is so significant that when we look at the input costs, they are at the highest in 17 months, whereas output costs are at their slowest since January. And what that's telling us is that businesses are essentially eating those input costs and not passing them on to consumers. If they're not passing them on to consumers, ostensibly, they don't think that consumers can withstand it. They don't want to drive away business. So if businesses are saying we're not going to pass these costs on to consumers because that might dent demand, well, then that suggests that their assessment of that demand is fairly dour, that there is a weakness that is underlying here for Australian consumers, which, of course, in Australia, as in every major economy, are the driving force of growth, accounting for the overwhelming majority of GDP expansion, which underlines an interesting disparity as we head into this inflation data. The markets are pricing in rate cuts this year from the RBA. We can see here that we are at 4.35 on the cash rate now. We're expecting to be at 4.10 on the cash rate in December. Do that math and you end up with a difference of 0.25. That is exactly one full-sized rate cut. But that is not what's going to happen if you ask the Reserve Bank of Australia itself, which just published minutes from its August meeting where it revealed that policymakers were not debating a cut, they were debating a hike because they are concerned about sticky inflation, in part because of what's happening with input costs. And the answer to which one of these sides of the argument ultimately is the more accurate description of what's coming next might be decisive not just for Australia and not just for Australia's dollar, but more broadly. As we just said, Australia is a major commodities exporter. Take a look at the things that it tends to export: coal, iron ore, wheat, gas. The portion of its exports that's made up of mineral and energy commodities and metal smelting inputs is dominant. And look at who its markets are. Mainly China and other locations in the middle of the global supply chain. Obviously, Japan is up there and is a relatively advanced economy, but nevertheless, in many ways, externally facing. Still, it is this here, China, Taiwan, Singapore, Malaysia, Vietnam, Indonesia, India. These are core value add middle of the global supply chain economies. What would it tell us then that Australian consumers are feeling skittish such that businesses are not able to pass rising input costs down because they fear demand destruction? Well, obviously there is a time lag in doing business such that if some smelting operation in China making steel would like to continue to feed that with iron ore imports from Australia, then that smelting operation needs to make up its mind about how much steel it thinks it can sell, look ahead, forecast how much iron ore it's going to need, and buy accordingly. And in between all of those decisions, there's a significant amount of elapsed time. So that if demand downstream for steel and things made of steel, like cars and washing machines, if that ends up being weaker than expected, it takes a while for the likes of Australia to see that weakness, because that smelter will have ordered iron ore well ahead of having the need for it, because obviously it's going to take some time to process the ore, create the steel, sell the steel, have the steel go into production for end demand, and so forth. Whatever weakness occurs in global demand will hit Australian consumers with a lag, because they will still be seeing essentially income from orders that were agreed earlier. If Australian consumers then are looking skittish in this economy that is overwhelmingly feeding the global supply chain with crucial commodity inputs at scale and early in the process, then we might suspect that whatever negativity might be happening in global demand is already advanced to such an extent that it is beginning to echo back into Australian consumers. Essentially, this will be already now a signal that the global downturn, of course, if the signal holds, that the global downturn is already underway, not just being foreshadowed. And this, of course, is lining up very interestingly with what we've already seen in global demand dynamics. We can see here from the worldwide PMI numbers, as we've pointed out here before, that global economic activity has already been slowing for 2 consecutive months. We don't have the August numbers yet, although we certainly saw some major economies reporting last week. But we still don't have, for example, Chinese numbers for August, so this is not quite updated yet. But the concern, of course, is that we are going to see a third month of deceleration in August. And the trend in global economic data relative to forecasts seems to imply that the bias is toward downside surprises. All of which is to say, if you get a downside surprise or a weakness in this consumer price indicator from Australia, the story will have been that the reason output costs that facing consumers are falling, according to the PMI data, is not because input costs are weak, but because businesses aren't passing them on. Which is to say, Australian consumers are weak, which speaks to a softening of demand in a pivotal, telltale economy. And this entire narrative distills into what we are seeing here. A soft inflation number, then, that suggests the RBA is going to have to come the market's dovish way and start to endorse this idea of incoming rate cuts. If that takes the Aussie dollar off these highs and sends it lower, the implication will not just be that the RBA has had to acquiesce and we now have a move in the currency market that is a tradable opportunity, perhaps, if we can structure it correctly. But also that there is an ominous signal here for global growth more broadly, with potentially negative implications well beyond the Australian dollar and very pointedly aiming at global stocks. And that is macro money for today. as ever. We are here Monday through Thursday, right after overtime. A show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what may follow thereafter. I'm on with Victor Jones for the Price of Truth tomorrow. On with Chris again for Futures Power Hour on Friday. On with Victor and Tom for First Call on Sundays. Writing for the News and Insights portion of tastylive.com. And opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Macro Money is back tomorrow. In the meantime, good luck trading. See you then.